You obviously like it when people buy from you. But what happens when somebody comes in to sell their silver or gold to you?
So most of my career, which is 35 years now, almost 36 years, Robert, whatever product you would be selling, you would receive a premium, a excess premium above the spot price, above the melt value, whatever the product was. Some products would have a higher premium than others, but there was always a premium. We can use Silver Eagles as an example, and I can show you what you're really getting at here using Silver Eagles. So let's just pretend that you called me November 2019 and said, I'd like to buy a mint box of Silver Eagles, 500, 1 ounce, brand new United States Silver Eagles. Sure. You say, Andy, what will you sell it to me for? And if I should need to sell it back, what will you buy it for? I would have said to you something like this. Now, this would have been the same answer I would have given you for pretty darn well near 30 plus years. And I would have said, sure, Robert, I will sell it to you for $3.29 over the price of silver. I'll buy it back from you for $2.79 over the price of silver. That spread, $2.79 to $3.29, 60 cents or so, would have been our commission per coin. So $300 on a mint box. That would have been for almost my entire career. That would have been standard. Now you say, okay, I'll do that. In fact, I want to get $100,000 worth. Sure. This is November 2019. You call me back 6 months later, March, April, May 2020, the pandemic had hit. Andy, the pandemic really affected my business. I need to sell those mint boxes. You told me that you would pay me $2.79 over. Is that still good? I'd say, no, it's not, but how about $11 over? Because the demand was so high for the price of silver, and for silver American Eagles, that in 6 months, the premium went from $2.79 over bid price to over $11 over the price of silver bid price, where it stood for most of the last, or 2020, 2021, 2022, 2023. And then things changed. They changed in a very substantive way. And that's going to get us to where we are now. So at least in terms of looking at where we were and where we were before that, you always would receive a premium above spot, but a small one. Then came the pandemic. The premiums went much higher, but let's discuss, before I get to where we are today, how those premiums are derived. Now, there's about 5 or 6 massive primary distributors. These are the distributors that work directly with the mints and the refineries globally. These are the companies that some of them are publicly traded. They spend billions with a B of dollars buying and selling precious metals every year from the global mints: South Africa, United Kingdom, Australia, Canada, and the United States, and Austria, the 6 primary mints. And their job is to provide liquidity to the market, to be a market maker. So let's go back to the pandemic. These primary distributors who have agreements with, let's say, the United States Mint, they take everything the mint will give them, because there's so much demand. The mint says we're out of product. That's it, no more product. These primary distributors then become the market makers moving forward. They are the ones that set the premiums either to the upside or to the downside. There's so much demand in 2020 and 2021 that they say, we'll pay anyone that wants to send us their Silver Eagles $11 over the price of silver, but we're selling them at 12 or 13 or 14 over. Now that spread, which was much bigger than normal, was big because you can't hedge the spread or the premium. You can only hedge the metal content. So anyways, first and foremost, your guy in Arizona really is not the one who sets the premium. It's whoever he's going to sell it to, the big primary distributors. They're the ones who set the premium. What's interesting about right now, maybe the most interesting thing about the environment we find ourselves in right now, and why the premiums are so low, is that really starting in 2024, we had the rise of NVIDIA, the accentuation of the Mag 7, the huge demand for cryptocurrencies, Bitcoin. You've talked about that for a long time. And so the American public did this 180 during the pandemic and the banking crisis, from risk off to risk on. And we saw a lot of selling and non-participation in the metals market. So the premiums went down. But here's where it gets really interesting. Where we are right now is a very unique situation, because you still have the American public who has yet to really take your advice, Robert. They're beginning to. they're waking up. But this is simultaneously happening when the COMEX market is experiencing the largest deliveries that they've ever had in the history of the market. In fact, the May delivery contract for COMEX, where the prices are set globally, delivered the largest amount of gold and silver in the history of the COMEX ever. The biggest money up here, they're standing for delivery. They're the ones pushing the price higher. The public hasn't. The public has a very tiny, if any, allocation to precious metals. In fact, Rick Rule says 0.5% across the entire United States, from Joe and Jane six-pack to the Harvard Endowment Fund in terms of allocation to metals. So what that means is there's more physical metal available on the street than the dealers have the ability to sell. And so as more people come in, the bid prices are getting lower and lower and lower. At the same time, the people at the top are draining the world's exchanges. It's just a matter of time. So anyways, all I'm trying to simply say is this. Until 2020, premiums were almost consistent forever. You pay a few percent over spot when you buy, you get a couple percent less, but still over the price of spot when you sell. Since 2020, everything's gone crazy, whether it be premiums that are higher than anything I've ever seen in my career, to where we are right now. And in defense of this gentleman, I will say industry-wide, the premiums are lower than I've ever seen, ever in my career. And it's not us, it's the people one step above us, the primary distributors, that are the market makers. That's really as honest of an answer as I can give you, is that when I take in $1 million worth of gold and silver, if I can sell it to my clients, great. But if I'm a coin shop in Arizona, I may not have that ability and I may not have that liquidity. So I have to turn around and sell it to a company like me or a company above me, the primary distributor, and the bid prices are going to be lower because there's so much excess supply built up, because the public has been chasing profit instead of realizing what the biggest money in the world is doing, standing for physical delivery. And it's a cycle, and we're at the bottom end of the cycle now. I would expect to see premiums move much higher industry-wide as there's more awakening in the American public who finally start to say, Robert Kiyosaki was right a long time ago. I should have been buying silver and gold. And when that happens, just like that, the premiums will flip.
Let me tell you, the real market isn't what you see on a screen. It's what you feel when you phone a dealer and ask, "What's your silver bid?" That's where the story begins. Think back. For nearly 3 decades, I could confidently quote a spread on American Silver Eagles, roughly $3 above spot to buy, $2.80 to sell, depending on volume. That spread covered costs, gave a bit of profit, and told you where things stood. Clean, predictable. The system worked. Then 2020 hit. Remember when COVID lockdowns began? Silver and gold went ballistic. Silver Eagle premiums surged past $11 above spot and sometimes higher. Premiums that never existed became the new normal. That wasn't just price. It was panic. Manufacturers, investors, ETFs, all wanted metal, and the pipeline couldn't keep up. I explained it to folks like you. When demand wildly exceeds supply, dealers can dictate the terms. That's why premiums soared and spreads widened. Fast forward to mid-2024, and we've arrived at a new reality. Premiums are now lower than ever across the board. This isn't because metal is abundant. It's because demand from the public cratered. Crypto, tech stocks, everyone chased that high. So dealers, faced with too much metal and too few buyers, lowered premiums to drive sales. That downward move on premiums isn't good news, it's a signal. The big money, the systemic buyers on COMEX and LBMA, are loading up. Meanwhile, retail is checked out. Folks, that's exactly the stealth build-up stage. So how do premiums work in practice? Let's say you call me now wanting a mint box of 500 Silver Eagles. In 2019, premium was $3, easy. In 2020 to 2022, it ballooned to $11+. Today, maybe $1 to $2 over, or even lower. It might even be closer to spot if you're moving big volume. But that micro-cost conversation belies a macro story. While you're paying less or nothing, data shows COMEX deliveries are setting all-time records. That means big players are standing for delivery, taking real physical metal. When that happens, supply evaporates. But since retail isn't showing up, there's no retail squeeze yet. Instead, metal flows to the big players. Premiums stay artificially low, for now. Let me paint that with numbers. In May 2025, COMEX saw its largest ever combined gold and silver delivery ever, surpassing all previous records. Who stood? Nobody tells us. But this is huge money, the kind of institutional capital that moves markets. At the same time, premiums for silver eagles cratered to historic lows. That's not coincidence, it's design. When you see low retail premiums and massive institutional deliveries, you're looking at a colossal physical transfer of wealth. Across all this plays a question most miss. Who controls the price? Is it retail demand, or is it the big metal mover making these historic deliveries? The price will eventually reflect institutional activity, not fleeting retail trends. Eventually, I expect premiums to rebound, much higher, because once retail wakes up to a crisis of supply, that demand hits like a tidal wave. Besides eagles, let's look at institutional-grade bullion. That market typically trades at small percentage premiums over spot. But over the last few months, those premiums have shrunk or even flipped negative. Unheard of. Why would anyone sell at a discount? Because metal is everywhere in dealer vaults, and nobody's buying. Yet simultaneously, exchange inventories are drying up. London Metal Exchange silver float is at record lows, under 155 million ounces, while daily turnover is 1.5 to 2 billion ounces. Yeah, that ratio is nuts. Lease rates shooting above 8% confirm the strain. Imagine borrowing silver at that rate. That's a meltdown in trust. What's happening is not subtle, it's systemic. But how about platinum? Lesser talked, but no less telling. Its lease rate soared to nearly 18%. Think about that. Nearly a fifth of your metal costs just to stay short. That's not a sign of abundance. That's desperation. Something's broken. When multiple metals across the board show lease rate stress, you don't need a PhD to recognize a broken system. So, is this metals mania? A speculative bubble? It's a physical liquidity event, not paper-driven, but real. Institutions standing for delivery, exchange floats evaporating, lease rates climbing, premiums collapsing. This is a market de-risking. The legacy COMEX system was always designed for incremental adjustment, not global accumulation, but now it's playing catch-up with reality. Demand outrunning supply, trust evaporating, and structural dislocations everywhere. Let me add color. I've spoken with mints in Canada and Australia. They're telling me they are operating at capacity. Bars of wholesale kilo size are shipping out monthly with no pause. And we're just entering peak season. This isn't seasonal rotation. It's ongoing. It's fueled by central banks hoarding metal, industrial buyers restocking on lower spot, and cleverly positioned investors who've smelled the physical imbalance. Who knew NATO countries would drastically reduce sales of their gold reserves? That's strategic. Now when NATO sells, they sell at par. When they buy, they hoard quietly. As premiums begin to rise under renewed retail interest, physical metal may vanish from dealer inventories. Imagine wanting a mint box at $2 over spot and only seeing quotes at $20 over spot, or worse, reflecting pre-orders months out. That's exactly what happened in 2022. Premiums spiked, weeks-long delays became normal, and delivery timelines stretched beyond belief.
The silver market and to an equal degree, the platinum market, to me, are under great stress at the futures level. And it seems to me prices are disconnecting on the futures from the real physical prices. You have a situation where it seems to me that traders across the globe, whether it be in London or in the United States now, are rushing to secure metal to avoid the risk of physical shortages. And physical shortages at that level are very prevalent right now. We can start with the London Metals Exchange. The London Metals Exchange is a 140-year-old exchange. It's the oldest in the world. And according to an article that just came out by a TD Bank analyst, it's the lowest free float ever. He argued that the outflow of silver out of the LBMA because of the tariff arbitrage, which I don't really agree with, because I think that was the cover to reshore all the metals. I think it's much deeper than that. I think someone got into Trump's ear and said, listen, man, if you don't do this, if we don't bring this shit back, it's a big big problem. The rest of the world is doing it, and I think he understood that. But what he came out and said is because of that, the inventories of freely available silver, we call that the float, is the lowest level in recorded history since they've ever been keeping records, ever. And so I think the number was 155 million ounces. That's less than a day's worth of trading volume for spot silver in London. And this is a short squeeze in what arguably is the world's most important silver trading hub. At the same time, as a result of that, you have a dramatic spike in the cost of the 1 month lease rate or borrowing silver. It's gotten as high as 8%. This is a level that you never see. So you have to pay 8% to borrow silver to cover a short position, perhaps. And this illusion of liquidity from the silver markets, Jared, in my mind, only rebalances, and I think in this analyst's mind as well, through some sort of a squeeze where the physical price has to go much higher. It's already up 33% this year, outpacing gold basically, but it has to go higher. Now, the LBMA, just to underscore that as an aside, is a T+1 market. I think we talked about this before. That's T+1 day. T is trade day plus 1 day to settle. On the third day, your metal should be moving. If you own a multinational gold and silver jewelry company and you need these bars to fabricate your jewelry to sell all around the world, and you have these contracts, you stand for delivery, you need it, you're going to start making jewelry. Well, sorry, man, we know it's T+1, but the Bank of England is telling us it's a shortage of manpower and trucks, that they don't have enough, so it's as long as 8 weeks you're going to have to wait. What that really means is they're caught with their pants down. Now, that 155 million ounce float, David Jensen is someone you would love to have on your show. I'm going to try to get him on mine. He's an analyst for the LBMA, and he's phenomenal, and he has a Substack. Okay, so he says that this free float is 155 million ounces, but they're trading that entire amount every single day. In fact, his numbers were higher, 180 or 90 million ounces every single day, which would be the entire float every day.
Now, when you step back and think about this from a macro level, what you're really witnessing is not just a market anomaly, it's a full-on reordering of trust and power in the global monetary system. And I don't say that lightly. For decades, the COMEX and LBMA were the temples of truth in pricing precious metals. But when the emperor has no clothes, when contracts are flying around like confetti with no metal behind them, when you've got 180 million ounces changing hands in London on paper, but only 155 million in total float, well, how long do you think that game can go on before people say enough? The truth is, the system's bluff has been called, and if you look closely, you'll see the biggest players are the ones flipping the table. They're not trying to win the game anymore. They're exiting the casino with physical bars under their arms. Now look, I get it. You've got folks out there saying, but Andy, the premiums are so low right now. Doesn't that mean there's no real demand? And I laugh, not because it's a dumb question, it's a great question, but it shows the difference between retail perception and institutional reality. You're measuring interest by public demand, while the whales are measuring it by risk. What we're seeing is not apathy, it's actually the calm before the stampede. It's like the tide pulling way out before the tsunami hits. And make no mistake, when that wave comes, the premiums won't just inch up, they'll rocket. You'll see the same silver eagles that dealers can't move right now at $2 over spot suddenly fetching $10, $15, even $20 over. We've seen it before, we'll see it again. The difference is, next time, you might not be able to get product at all. Let me tell you a story. During the banking crisis in March 2023, yes, just over a year ago, one of our clients called in, and I'll never forget what he said. I should have listened sooner, he told me. When I saw my bank stock go to zero overnight, I realized I didn't own money. I just had digits. That hit me hard. It's the kind of thing we all feel in our gut but don't want to say out loud. But that's the reality for most Americans right now. They're walking a tightrope over a pit of counterparty risk, and they don't even know it. Their brokerage accounts, counterparty. Their IRAs, counterparty. Their bank deposits, counterparty. And then there's gold and silver, real, tangible, unencumbered. It doesn't rely on someone else's promise. It just is. And while retail hesitates, the central banks are going full throttle. Let's take a look at China. I don't care what the mainstream media says. Beijing isn't buying gold for decoration. They're preparing for something. Since 2022, the People's Bank of China has reported continuous monthly gold purchases. They're now sitting on a declared 2,262 metric tons, but those are just the official numbers. Most insiders, including folks at the World Gold Council, estimate their true holdings are closer to 5,000 or even 6,000 tons. Why the secrecy? Because they're de-dollarizing in stealth. They're not going to shout it from the rooftops. They're going to unload treasuries quietly and scoop up gold with both hands. And they're not alone. The BRICS nations are following suit, and there are growing whispers of a gold-backed BRICS trade settlement system. And here's something else. People forget that this isn't just about America losing reserve currency status. It's about what happens next. If you remove the dollar as the core of the system, you need something else that can anchor trade. And the only asset that carries no liability, that doesn't rely on a central bank's promise, that's universally trusted, is gold. It's not Bitcoin. It's not the euro. It's certainly not the yuan. It's gold. Full stop. And if gold's going to serve as the backbone of a new financial system, what does that say about the relative price of silver, which historically has followed and even outperformed gold in these monetary resets? We're not just talking about potential price increases. We're talking about revaluation, repricing, a seismic shift that pulls silver out of the industrial category and back into its rightful place as monetary metal. And let's not forget the industrial side. Silver is no longer just jewelry or coins. It's the irreplaceable metal of the green revolution. You want solar panels? You need silver. You want electric vehicles? Silver again. 5G technology? Medical instruments? Water purification? All silver. And here's the kicker. These industries don't care what the spot price is. They'll pay whatever they have to because silver is non-negotiable in their supply chains. You can't swap it out. So while Wall Street is playing hot potato with paper contracts, the real-world users are biting their nails, praying the supply chain holds. Now, I want you to think about what happens when both sides, monetary and industrial, collide. You've got hedge funds realizing the paper market is a ticking time bomb. You've got sovereigns looking to hedge against a Western debt spiral, and you've got industrials locking up supply to meet exploding demand. That's not a recipe for volatility. It's a recipe for a melt-up, and it's already underway. Just look at the lease rates we talked about earlier. You don't get 8% lease rates unless traders are terrified of delivery failure. That's not normal market behavior. That's desperation. And it's not just silver. Platinum's lease rate hit 18%. That's Banana Republic territory. That's markets sending distress signals in Morse code. And nobody in the mainstream is even picking it up. But you know who's picking it up? The insiders, the big money. And they're doing two things: buying physical and standing for delivery. Look at the COMEX delivery data. May was the second largest silver delivery month in history. Let me repeat that. In history. Who is standing for delivery? It's not mom and pop. It's not coin shops in Tucson. It's sovereign wealth funds. It's billionaires. It's entities that don't want settlement. They want metal. They're treating the COMEX like a vending machine. Punch in the code and bars come out, at least for now. And this is where things get existential. What happens when there are no more candy bars in the vending machine? What happens when the COMEX says, "Sorry, we're out"? The system is built on the illusion of infinite supply. But when reality intrudes, the entire pricing mechanism breaks. That's when you get a physical reset. That's when the market starts trading on what's available, not what's promised. And when that happens, the paper market dies. Maybe not all at once, but like Hemingway said about bankruptcy, gradually then suddenly. I'll leave you with this. The day is coming when premiums will no longer be a function of dealer margin or mint supply. They'll be a barometer of panic. When the crowd finally gets it, when they realize their ETFs don't have bars, their vault receipts are IOUs, and their brokers can't deliver, that's when they'll storm the exits. And by then, the door will be closed. Not locked. Closed. You'll knock and knock and knock. And the answer will be, "Sorry, we're sold out." So if you're watching this, let me say it plainly. You are early. You are among the few who still have the luxury of time, the option to accumulate quietly. while the herd is distracted by AI stocks and TikTok inflation theories. Use that advantage, build your position, and when the next spike comes, and it will come, you'll be on the other side of the panic. You'll be the one with bars in hand, watching the premiums explode, knowing you already locked in your wealth while the world hits snooze on the alarm clock. And if you're still wondering whether now is a good time to buy, let me ask you this. When in your life have you seen an asset with collapsing premiums, all-time high central bank demand, record delivery, record short positions, skyrocketing lease rates, and vanishing supply all at the same time? I've been in this business 36 years. I've never seen it. Not even close. This is the setup of a lifetime. Ignore it at your own peril. But if you're paying attention, congratulations. You're ahead of the curve. And in this game, that's how fortunes are made. Not by following the crowd, but by seeing what's coming before everyone else.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.